Started.
Ready?
Hi, I'll share my video. All right. Hi, everyone. Welcome to our webinar today on timing is everything. Drew and I are going to be talking about beginning of year planning strategies.
All right. Or should we say that Maddie's going to be talking about beginning of the year planning strategy?
Both of us.
All right. Both of us.
Okay. So I'll start us off. So when is the best time to take your required minimum distribution? And this depends upon your specific situation as well as other factors. So we'll talk about what factors would make you take your required minimum distribution at the beginning of the year, as well as the benefit to waiting later in the year to take it.
Right. And most people think that you're supposed to take it at the end of the year, but that's not always true. So let's go into them, Maddie.
Okay, so some factors of when you should take it early in the year is if you're over age 80, if you have poor health, if you are, what this is morbid to say, but it's something that we have to consider, is if you have an early death in the year, this would cause you to only have a couple months of income for that year, as opposed to the full year, 12-month year of income. And another factor is if you're in a lower tax bracket than your children.
Yeah, let's explain that real quick. Okay. So my mother is in about the 15 to 22% tax bracket. Pretty much every one of her children run in the 35% or higher tax brackets. If mom were to pass away without taking her required minimum distribution at her low tax rate, all of her higher tax rate children will have to take the required minimum distribution and will be taxed to the beneficiaries, not to the decedent. And there's no way to reverse that if the person dies before taking that required minimum distribution. So you're right, it is kind of difficult and somewhat morbid to have to talk about this, but from a tax point of view, this is the way our minds work. My wife always says to me, your mind literally works a little different than the average person, but that's the way we have to think about it, Maddie. Yep. And so if you're over 80, poor health, these are things that we have to think about, taking it early in the year so that the tax preferences stay with the lower tax bracket person. Not to mention, well, let's look at the next one. When do you take it late in the year?
Okay. So if you wait till the end of the year, you have a better idea of what your tax situation will be for that year, as well as I'll let Drew talk about the market timing.
Yeah, so, if you wait until the later part of the year, you can, if the market's down in the beginning of the year, you can wait and hope the market recovers. Why? Well, because if I have to take out 10,000 and in December of the year before the market starts declining, and so by January or February, the market's down 20%, that means what it would have been $10,000 maybe a month or two ago might now only be worth $8,000, a 20% decline. So I'd actually have to take out more money to hit the 10,000 based on the decline of the market, or should I say, I might have to sell more securities than I would have a few months ago to get that money to be 10,000. If I wait until later in the year and the market recovers, I only have to liquidate a little bit of securities to get my $10,000. So, sometimes when you have a bad market at the beginning of the year, you might want to wait and see if it recovers. And that way you can take out less securities to fulfill your required minimum distribution.
Mm-hmm. And the next point is kind of reverse of what we talked about of taking the beginning of the year. So if you're in a higher tax bracket than your children, it may be beneficial to have them take it out and they pay the taxes in a lower tax bracket.
Right.
As well as like last year when we had the pandemic and everything, the government took away required minimum distributions for the year. So if you had waited after that they had let out that rule, then you wouldn't have had to deal with putting it back in, and then you wouldn't have to take it out for the year.
Yeah, so like you say, if you're in the highest tax bracket, we have a client who's definitely in a lot higher tax bracket than all of his children. We prefer that client to wait until the later part of the year to take out because if it did end up going to the children, it would actually be a tax advantage in that situation. People keep asking, is the government going to take away RMD for 2021? No. They normally only stop the required minimum distribution if you have a very, very bad stock market. And like you did in 2008, they did it for the very first time ever. And like you had last year in the beginning of the pandemic. Don't expect it in 2021. And this is a very good market right now. And so there's no reason to delay if you had any of our early reasons to take it out.
All right. So the next thing that we'll be talking about is a qualified charitable distribution. Some of you may know what this is, but in case you don't, it is a withdrawal from a traditional IRA that is given directly from a charity. And with this withdrawal, it is tax-free. Neither you or the charity pays taxes on the withdrawal. So instead of you making a contribution to charity with cash in your bank account, which you've already paid taxes on, why not take it from your IRA and give it directly to the charity and avoid taxes there? If you do a qualified charitable distribution, it can take place or reduce your required minimum distribution for the year. So it's sort of a win-win there. But to be able to make a qualified charitable distribution, you must be at least 70 and a half years of age.
Absolutely. This is critical, Maddie, that all of our clients who are over 70 and a half, and trust me, don't ask me why 70 and a half. Why not 70 and 3/4? Why not 70 and 5/8? I don't know why 70 and a half, where'd that number ever come from? But it is, you actually have to be 70 and a half. And this is better than trying to take it as an itemized deduction. And actually, under the new tax laws, very few people actually can itemize their charitable deductions. This eliminates that. This says that if I have that $10,000 required minimum distribution again, I can give it right to charity or a portion to charity and not pay a nickel in taxes on it. This is a brilliant strategy that every single client should be taking advantage of if they're charitably minded. Don't do this just because you think it's going to reduce your taxes. You only do this if you're charitably minded. If you're going to give to charity, do it this way.
Yep. So when is the best time to make a qualified charitable distribution? We say at the beginning of the year. So if you're over 70 and a half, plan to do this instead of giving cash directly to the charity. So if you do it at the beginning of the year, this gives charity that money up front for them to use during the year. And charities need to learn how to use it properly throughout the year and adjust from that old way of doing it, whether you give it to them monthly or weekly. But if beneficiaries normally cannot do a QCD because they're rarely over 70 and a half, so it's beneficial to do it if you are over 70 and a half. And most charities are getting used to that. We're getting used to that auto monthly withdrawal. And again, this is a concept of the past. Most charities now know how to deal with getting it upfront in the year.
But if you are a beneficiary of an IRA that was not a spouse of yours, and you're over 70 and a half, an inherited IRA can be given to charity just like any other IRA, but still it has to be over 70 and a half. And if I had my own IRA and I had an inherited IRA and I had to make a choice as to which one I'm going to give my qualified charitable distribution, I will always recommend the inherited IRA. But again, it still have to be 70 and a half.
Yep. Okay. So when is the best time to make contributions to your traditional IRA or your Roth IRA? So if you know that your income is below a certain threshold and you are able to do a direct contribution to a Roth IRA, we recommend that you do that as soon as possible. So you're aware of those AGI limits. For 2020, if you make under 139,000, you're able to do a direct to a Roth. It's 140,000 for 2021. If you're filing married, it is if you're under 206,000 for 2020 and under 208,000 for 2021.
So
However,
those income limits, that's the highest range that you can put at least something in. There's a
right,
phase out that's about $10,000 or $15,000 lower than those numbers. I just want to clarify it that if your income's 135, that doesn't mean you can do a full 7,000 or 6,000. You're going to probably be phased in. So that's the highest number, right, Maddie?
right, correct.
Yeah.
Sorry.
Go
Thank
ahead.
you for clarifying. So if you are over those limits, there is still an option for you to get that after-tax Roth money, and it is what is called a non-deductible IRA contribution. So with this, the process is you contribute to a traditional IRA on a non-tax deductible basis, meaning you're not getting that tax deduction. Then a couple weeks or a month later, you move that over to your Roth. It's sort of a workaround to getting it money in the after-tax account. However, with the cloudiness of tax laws, it's important to do non-deductibles as soon as possible because you never know, the government could take away this strategy.
It's complicated.
Right.
And so you really need good tax advice when you do this. Not everybody can do it, right?
Right.
So,
yeah.
So we got it till, well, yeah, so that's you're absolutely right that there are times to do them, but you really need to know what your income's going to be. If you're going to do it at the beginning of the year, you got to know exactly what it's going to look like by the end of the year.
Right. So the maximum contributions that you are able to contribute is $6,000 per person if you're under age 50 and $7,000 if you're over 50. So a married couple under 50 could do a total of 12,000, and a married couple over 50 could do a total of 14,000. The deadline for these contributions is April 15th of the following year for the previous year's contribution. So for 2020, you still have time to make contributions for 2020. You have until April 15th or whenever you file your tax return.
Yep.
So health savings account contributions. So at the beginning of the year, ensure that you have a plan for how you're going to contribute to your HSA for the year, whether it be you have a certain amount deducted from your paycheck throughout the year, or you plan to do a lump sum. If you do it through your paycheck, it reduces your gross income for the year. And these max contributions for 2020, if you're on an individual plan, is $3,550 for 2020 and $3,600 for 2021. If you're on a family plan, it's $7,100 for 2020 and $7,200 for 2021. If you are over age 55, you can do an additional $1,000 as a catch-up. The deadlines for this is similar to the IRAs. You have until April 15th of the following year to do the previous year's contribution.
Now this one's easy, Maddie. This one you always do in January if you know you have a high deductible health plan and you're likely to have it the full year. That's an easy one. It doesn't matter if my AGI is $1 million or $10,000. This one, all I need to know is I have a high deductible health plan. I have an HSA. I can contribute the money. I do have an HSA, and I always contribute to it in the first couple weeks of January because I know I'm going to have the plan the whole year. There's no reason for me not to have it in the plan, available for medical expenses, and earning money tax-free. So This is an easy one. Wouldn't you agree?
I agree, 100%. So company retirement plans, so 401ks, 403bs, simple IRA. So similar to the HSA, at the beginning of the year, ensure that you have a plan for how much you're going to defer into your company retirement plan. Throughout the year, make sure that you're keeping track of how much you defer. So these maximum deferrals that you're allowed to do. So if you are over age 50, you're allowed to contribute a total of $26,000 for the year. If you're under age 50, you are able to contribute or defer $19,500. So if you have a simple IRA, those limits are, if you're under 50, you can contribute $13,500. If you're over 50, $16,500. So the deadlines for these are different from the IRA and the HSA. These have to be made within the calendar year of the contribution. So December 31st.
Yeah, and on these, this is so important at the beginning of the year to check on this, because what happens is you normally, how many people sit there and study their pay stub after the, you just, it got into your checking account. That's all that matters. And so if you don't know that you're hitting your max throughout the course of the year for your payroll deductions, you're going to wake up in September or December and say, gosh, I'm not contributing the max. I'm off by whatever. And they do change these frequently. So make sure at the beginning of the year, you're hitting your max deferrals. Very important one right here.
Easier to have a little bit or a certain amount taken out of your paycheck.
Your voice went blurry on us. Did you hear me?
Yeah, I can hear you.
But yours has gone blurry. Huh. I don't know why. No. Try again. No. Huh. I don't know what's happening. Talk again. Let's see what's happening. No. But maybe I'm going to have to keep doing it on my own for a little bit.
Okay.
Blurry here too. See that? Are you hearing me fine, Patricia? Are you hearing me fine? Yes, she's hearing me fine. So, well, let's see if you could come up with something that's causing that, Maddie.
Okay.
And I'll keep going. So go ahead and hit me with the next slide.
Okay.
So keep track of cash flow in the early in the year. So this is my biggest recommendation. This is the strongest recommendation I can make, is every year keep track of every dollar you spend and categorize it. In other words, if I go to Starbucks and I buy a cup of coffee, I put it down under coffee or whatever. If I go and get a haircut, I put it down under haircut. If I go to the grocery store and buy groceries, I put it under grocery. If I buy a bottle of wine, I put it under wine. I want to categorize it. Why? Because at the end of the year, I want to know what I spent on that category. I don't want to know that it only cost me $3 or $2 for a cup of coffee. That sounds like a trivial amount of money. But at the end of the year, if I look and I did it every day for 365 days of the year, I want to know that I just spent $1,100 at Starbucks on coffee, and then I can process that in my mind and say, is $1,100 a reasonable amount that I want to budget? It may be. There's nothing wrong with it being that, and so go ahead and do it. But I just want you to know $1,100, not $3, not $2. Because when you put things in categories over long periods of time and then compound it not over each year, but over a decade, those numbers become different and your mind thinks of them very differently. Cash flow, one of the most important things to do at the beginning of each year.
Mm-hmm. Yep. Make goals and.
Hey, you're back.
Is my voice better?
Yeah. Were you underwater there a second ago?
I think it flooded in here for a minute.
Go ahead.
Yeah, so it's important to just make goals. That way you know what to work towards for the year. Develop a retirement budget and know how much you need to save to reach those goals. That'll help you plan for the year.
All right, what's next?
Okay. I'll let you take this one on. since you're the
No, you
tax
don't like
guru.
Roth conversions. Roth conversions. So if the market's up at the beginning of the year and you're thinking, hey, I want to have a certain amount of money that I'm willing to pay tax on this year, 2021, and the market's up, I might want to defer a Roth conversion because I'm going to make bigger bang for the buck if the market's down. But if the market's down at the beginning of the year, I might want to do my Roth conversion now because now let's go back again. I've got $10,000 in an account, and at the end of the year before, it goes down 20%. Now my 10,000 is only worth 8,000. I say, hey, I'm willing to convert that and pay taxes on 8,000. I convert it over to Roth, and now all of a sudden that 8,000 reverts back up to 10,000, which a lot of times will happen. Now, all of a sudden, that last $2,000, which was taxable, now becomes tax-free when it reappreciates in the Roth. So, you want to always be looking at the beginning of the year to see if markets are down a lot and consider, should I be doing a Roth conversion? Sometimes you want to wait and watch throughout the whole year. If you're terminally ill and you're headed into the year, again, Roth conversion, and this is something, unfortunately, we do. I don't mean it unfortunately in the sense that it's a bad planning strategy. I just mean that it's a kind of a morbid thing we have to think about. If a client tells us they're terminally ill, we say, we have to look at this. This is something we have to consider if you're interested in maximum tax advantages. So anyway, always do some good research with your tax advisor, with the consulate, before doing any Roth conversion.
I'll let you take the lead on this one as well.
So a question I get asked all the time. I don't need to worry about my itemized deductions anymore because I don't itemize anymore. Wrong, wrong, wrong. I don't agree with this anymore. I want to make sure that you still keep track of all your medical expenses, all of your property taxes, your charitable receipts, et cetera, et cetera. It might be a waste of time at the end of the year, but let me tell you a couple things. Number one, the current tax law we're under, where you don't itemize, is going to disappear in 2026. So if you get out of the habit of this, you could totally be caught off guard when the new tax law ends in 2026. In addition, there's a good chance that President Biden will say, yeah, I don't like this tax law anymore. I'm going back to the old tax law, or at least eliminate the maximum $10,000 deduction on state and local income taxes. And if that happens, a lot of people are now going to be able to itemize again. And so there's another good reason. And lastly, there's a new law that says you get a charitable deduction for $300 of cash. If you donate $300 of cash, you can take a charitable deduction on your tax return. And in 2021, a married couple will be able to take a $600 deduction for cash contributions. And that's regardless if you itemize or not. So keep track of your medical expenses, keep track of your charitable contributions, keep track of your property taxes, submit those to your tax people. And even if they tell you it's worthless, you're not going to hear that from us. We're going to want it. We want it, and we want you to keep doing it. So definitely keep track of those. Go ahead.
So just additional items. I'm sorry, what'd you say?
You get to rip through these.
Yes, I have this. So additional items to just think about at the beginning of the year. Review your state documents, make sure they're up to date with your wishes and they're not outdated, as well as check your beneficiary designations just to make sure they're still aligned with your wishes. Another one is check your credit report. You can use www.annualcreditreport.com just to make sure there's nothing fishy on there. Nobody's tried to open anything in your name. A way to prevent anybody doing any fraud with your credit is to freeze your credit. And we would want you to do this at the 4 credit bureaus. And if you are interested in doing this, send an email to the info@financialconsulate.com and we can go ahead and send you those links on how to freeze your credit there. Another one is set a schedule for regular financial reviews with your advisor. It's important for you to meet with them at least once a year to check on your accounts, answer any of your questions, and make sure everything is okay there. Exercise, it's important. People who regularly exercise are happier, and happier people tend to not need money or other things to cope. So exercise is important for your physical and mental health there. And last but not least, work on strengthening your relationships with your loved ones. That's why we're here, and that's a part of our mission statement, is it's important to tend to your relationships with your loved ones and to spend time with them.
And not let money destroy those relationships.
Exactly.
That's what it's all about. But, number 2, check your credit report and freeze your credit. We've been talking about this I've had my credit frozen for 14 years. I've talked about it off and on for 14 years, but in the last 4 years, we've been pounding the tables, freeze your credit, and we still find clients that haven't frozen their credit reports. And if you don't know what that means, make sure you contact your consulate advisor and get the information, how to freeze it, what are the benefits of it, and what are some of the nuisances. There are some nuisances to it, but it's incredibly important to freeze your credit. And I think you'll find it to be incredibly beneficial.
Mm-hmm.
You have some questions?
Yeah, we'll open up to questions. So it doesn't look like we have any questions as of now.
But we do have a chat here.
Yeah. So
in addition to credit freezes, which we've done at your suggestion, you recommend using an identity theft service like LifeLock, et cetera, et cetera. I'm not a big fan of LifeLock, though it will add some insurance and it will add some extra, things that they do. Me personally, I freeze my credit and then I put notifications and 2-factor authentication on every financial account I have. My bank accounts, my brokerage accounts, my HSA, my 401k, got 2-factor authentication. I've got notifications. If anything changes on the account, I'm immediately emailed or text, and I've got my credit files frozen. Other than the $1 million of identity theft insurance and the experts on hand to help you take care of things, you got everything LifeLock offers. But is it worth that for $200 or whatever it is a year for LifeLock? I don't know, but I don't spend the money on it. So you have to make that personal decision. There's another question. You go ahead and get that one.
Yeah, so the question is, our employer has an HSA debit card and the funds are invested in a cash account. So can we transfer the excess funds to an investment account with you? We can, I believe. No? Okay. No, unfortunately. I thought for
it is sort of the answer, Maddie. You're right, because that at the consulate, our HSA can be transferred to an investment account where we can manage it. Okay. But it all depends on who the HSA is, who the investment account is with, and does the brokerage account with that investment account come back to either Charles Schwab or Fidelity, and Fidelity probably won't let us manage it. Schwab always lets us manage it. So the answer to the question is, it depends who the investment group is, and do they allow a brokerage account, and is the brokerage account with Charles Schwab and Company? That would be a good probability. And that's why you think so, Maddie, that you can, because we can do it, because the brokerage account that we go to from Further, who is our HSA, is Schwab. So it is eligible, but typically HSA Bank and others like that don't use Schwab. They're using Fidelity or someone else, or they're only offering mutual funds. So that's the only investment option you can choose.
Right. So can we transfer the funds out of the employer HSA account to set up one with you?
You never want to. You want to keep the coordination with your HSA, with your medical insurance, because that gives you the accounting that you need to always prove if the money was withdrawn. Now, if you want to do a whole bunch of administration, there is a possibility we can set up an HSA and do a direct rollover, but we're not going to recommend it to a client. And as fiduciaries, we would prefer it stay with the employer's HSA. Any other questions?
Doesn't look like it. I think that's it.
All right. Well, that was fun.
That was. So we don't have a set date for our next month's webinar. We have a tentative topic on cybersecurity training, just to be aware of. But it's going to be at the end of February. So just stay tuned and we'll get you more information there once we have that set in stone.
Yeah, you know, that's going to be so important, Maddie. What we're going to be teaching is the things you should be watching to prevent from your computer getting corrupted, that now when you're emailing us about questions, some thief, some cyber thief is not watching and seeing what you're saying and then try to interfere to get you or us to do something that would be to your detriment. And the best offense is a great defense. And so we want to teach all of our clients as much as possible how to prevent your computer from being corrupted or from a cyber thief getting access to it. And it's all too common in today's world.
Exactly.
So great, Maddie. Thank you. You do a great job.
Thank you all for joining today, and have a great weekend. We'll talk to you guys soon.
Goodbye.
Goodbye.